Look at the market right now, and you'd assume all the explosive growth is locked up in software and AI. But right now, one of the most aggressive market breakouts of the entire year is happening in heavy industry. This chart tracks an 85% stock surge over the last 12 months, climbing relentlessly to peak near 6,100 rupees a share. This is the track record of Cummins India, a heavy manufacturer that has occupied a central role in the traditional economy for over a century. Today, their core product footprint consists of massive diesel and gas engines, along with the heavy-duty generator sets that keep industrial facilities running. To figure out how a heavy machinery producer secured a Silicon Valley-style valuation, we have to look under the hood of their latest financial reports. The spark for this recent rally came directly from their Q4 earnings report. They delivered massive full-year numbers, roughly 12,143 crore rupees in top-line revenue, and nearly 2,100 crore in pure profit after tax. But higher sales are only part of the equation. This bar chart demonstrates the real catalyst: EBITDA margin expansion. They are squeezing significantly more profit out of every single rupee they earn. We can see exactly how they are expanding those margins by looking at their FY27 strategic outlook. The market is pricing in a structural leap in profitability, driven by two specific massive economic trends. First is India's domestic infrastructure boom. Down here in the power generation segment, they are tracking a massive capacity target of 6 to 10 gigawatts. Look higher on the chart, where 35% of their domestic power gen revenue now flows directly from data centers. When massive new server farms are built for cloud computing and AI, they require industrial-scale backup power to prevent catastrophic outages. Cummins gensets provide that lifeblood. By capturing this tech-adjacent revenue stream, the company is seeing a financial re-rating as investors price in its role as a provider of critical digital infrastructure. They've positioned their heavy industrial hardware squarely at the center of the new digital economy's energy demands. That positioning comes at a premium. The stock currently trades at a lofty 38 times trailing earnings, with analyst consensus targeting between 3,400 and 3,900 rupees. Bulls argue that valuation is justified by the union budget's 11.2 trillion rupee infrastructure push, ensuring steady domestic demand for heavy equipment. Combine that with an RBI rate cut cycle that lowers borrowing costs for both Cummins and its heavy industry buyers, and the growth pathway looks clear. So the bull case relies on perfect execution within a highly favorable domestic environment to justify the high price tag. However, the risks to this outlook are highly visible. Look at the execution challenges here. Global demand is straining the supply chain, stretching the delivery of imported high-horsepower engines by 3 to 6 months. Along with physical bottlenecks, there is looming geopolitical friction. A proposed 26% U.S. tariff on Indian goods threatens to drag down their export volumes. With foreign institutional investors holding nearly 20% of the stock, any export slowdown that misses these aggressive growth targets could trigger rapid institutional selling. Cummins India proves that traditional manufacturers can capture explosive tech-driven upside, but securing those gains means walking a tightrope between demanding market valuations and the harsh physical realities of global supply chains.